Disclaimer: this video is for educational purposes only and should not be considered financial, investment, or legal advice. Always do your own research or consult a qualified financial professional before making any investment decisions. Welcome back to Money Mindset, the place where investing finally makes sense. Today we're diving into a topic that many investors are curious about: the world of high risk, high reward ETFs, the ones that move fast, jump high, crash hard, and attract thrill seekers looking for explosive returns. These ETFs can double in value during a good year, but they can also fall just as quickly. If you've ever wondered which ETFs are the most volatile on the market, why they move so aggressively, and whether they belong in your portfolio, this video will give you the full picture. Let's start by understanding why some ETFs are so unstable. Most of the time, volatility comes from three sources: leverage, emerging markets, and hyper-concentrated sectors like tech, biotech, or clean energy. These categories behave differently from traditional index funds like the S&P 500 because they magnify movements. When markets rise, these ETFs can soar. When markets drop, they can sink instantly. So the question isn't just whether they perform, it's whether you can emotionally and financially handle the ride. Let's begin with the most explosive category: leveraged ETFs. These are funds designed to multiply daily market returns, commonly to X or 3X. Next on the list is SOXL, the 3X leveraged semiconductor ETF. Semiconductors are already a volatile sector because companies like Nvidia, AMD, and ASML can shoot up or fall depending on demand cycles, new technologies, or macroeconomic pressure. Now imagine multiplying that volatility by 3. SOXL can surge 10% in a single day, or crash 10% just as quickly. It's one of the most dramatic ETFs on the market, perfect for traders who love adrenaline, but definitely not for beginners or long-term passive investors. Another big name in volatility is SPXL, the 3X leveraged S&P 500. While the regular S&P 500 is known for its stability, SPXL magnifies every small movement when the market is trending upward. For weeks, SPXL looks unbeatable, but during downturns, it bleeds quickly. Leveraged ETFs show you that high reward comes with high risk in a very literal sense. Now let's move to the second category: emerging market ETFs. These are risky not because of leverage, but because of economic instability. Take EM, one of the largest emerging markets ETFs. It includes countries like China, Brazil, India, South Africa, and others that grow fast but face political uncertainty, weak currency stability, and unpredictable regulatory environments. EM can have massive multi-year rallies, but it can also fall quickly when global markets panic, supply chains freeze, or political tensions rise. Another example is FM, the frontier markets ETF. These are countries even less developed than emerging markets, places where small events can cause huge price movements. The growth potential is enormous, but the risks are even bigger. These ETFs are incredibly volatile because their economies are still maturing, and small shocks can move markets dramatically. Frontier markets are not for the faint of heart, but they are fascinating for investors seeking long-term asymmetric bets. That brings us to the third category: hyper-concentrated sector ETFs. These funds often focus on industries with rapid innovation cycles, making them extremely sensitive to news, earnings, and technological breakthroughs. For example, ARKK, run by Cathie Wood, is one of the most famous volatile ETFs in the world. It invests in disruptive technologies, AI, genomics, Tesla, robotics, and it can rise or fall 10% in a week without breaking a sweat. ARKK gained over 100% during the pandemic boom, then dropped more than 70% afterward. That's the definition of high risk, high reward. Another example is TAN, the solar energy ETF. Clean energy companies often depend on political incentives, subsidies, and technological breakthroughs. When the sector is hot, TAN can explode upward. When sentiment shifts, it drops sharply. The same goes for IBB or XBI. To biotech ETFs known for huge spikes when new drugs succeed and huge crashes when they fail. Biotech is one of the most unpredictable sectors in the market, and the ETFs simply reflect that reality. So why would anyone invest in these high volatility ETFs? The answer varies. Some people use them to diversify into markets with higher long-term potential. Others like the excitement of fast-moving sectors. And some investors understand that higher volatility can lead to bigger returns if you can stay disciplined and avoid emotional decision-making. Volatile ETFs can fit into a portfolio, but only with clear rules and controlled allocation. 5% or 10% of your portfolio might be enough to add growth without taking on excessive risk. Before investing in any high-risk ETF, ask yourself 3 questions. First, can you handle seeing your investment drop 20% or 30% in a short period? Because with these ETFs, that can happen easily. Second, are you investing for the long term, or are you trading? These ETFs behave very differently depending on your strategy. Third, do you understand what drives the volatility? Leverage decay, political risk, sector cycles. Knowing the cause helps you avoid panic. At the end of the day, high-risk ETFs are not good or bad. They are simply tools. In the right hands, they can deliver enormous rewards. In the wrong hands, they can lead to massive losses. What matters is your knowledge, your risk tolerance, and your plan. If you enjoyed this breakdown of the most volatile ETFs on the market, make sure you hit like, subscribe to Money Mindset, turn on notifications, and tell us in the comments which ETF you want us to analyze next. We post new videos every single day, and we're here to help you invest smarter with every upload.